Hi everyone, part 3 of chapter 12, Riskier Mutual Fund Products. Okay, so now we're going to talk about specialty mutual funds. So specialty mutual funds are funds that restrict the investment objectives of that specific fund. Okay, so they tend to concentrate investments in securities or specific industries to a far greater degree than any other funds. So, for example, a specialty fund could focus completely on precious metals, or it could focus on all their funds be in the natural resource sector. Okay, so specialty mutual funds have risk factors consistent with the makeup of their investment portfolio. Okay, just like any other type of fund. So, for example, if gold funds rise and fall with the value of with gold and securities based on the price of gold. Okay, or if the price of gas goes down, then the same thing is going to happen to that specialty fund. Okay, so many specialty mutual funds have an additional risk factor that other funds generally tend to avoid, and that is the lack of diversification because it is specialized, right? So if everything in that fund is focused on precious metals and all of the value of precious metals starts to decline, then the fund is going to decline. There's nothing to help balance that specific fund out. Okay, so because of their specialization, specialty mutual funds tend to construct portfolios that are not as well diversified by industry sectors as more standard types of funds. So real estate funds are exposed to the risk associated with being in the real estate market alone. Or resource funds, the natural resources, tend to invest only in firms in the natural resource sector of the economy. So in comparison to standard Canadian equity funds, the lack of diversification in specialty funds can be striking. But it is not a good investment strategy for anybody's client to buy only a specialty mutual fund if they're not invested in something else. So if they're invested in other funds that are diversified, by bringing in this specialty fund, their diversification is still there. Okay, so the next is fund wraps. Okay, and a fund wrap program provides a series of portfolios with multiple mutual funds to reflect pre-selected asset allocation models. Each model is designed to meet the needs of a group of investors sharing a similar client profile. Okay, so in contrast to a balanced mutual fund, where the fund balances between fixed income and equity, a fund wrap generally outsources the management and security selection within each asset category to different managers. Okay, so then the different asset categories are diversified out to different managers, and then it's pulled together as one full wrap that their client would invest in. Okay, so for convenience, all administration, management, and trading costs are usually rolled into one wrap fee. So fund wrap investors hold the unitized value of the fund of funds, because that's what the wrap is, right? It's a fund that holds a bunch of different types of funds within it. And then those different types of funds are managed on their own, and then they are pulled into an overall fund. Okay, so fund wraps are available with advisor compensation either built in or excluded, which would be a fee-based approach, increasing the flexibility and acceptability of these products. So from a trading viewpoint, there is no substantial difference between fund wraps and the traditional mutual fund. So from a client's point of view, the purchase, redemption, and reporting process is the same as it is for mutual funds. And from a mutual fund salesperson's point of view, the process also is largely the same, with differences only around compensation. Okay, so from a regulatory point of view, fund wraps constitute a specific investment structure. Okay, so a fund of funds exists as a legal entity just like a mutual fund does. Thus, specific regulation provisions govern the development and the promotion of these fund wraps. Regulations include, for example, prohibition against double dipping, as in not being allowed to charge fees twice for the same service, and trading fund wraps as units is essentially the same as trading fund units. So a fund wrap can be funds of funds, okay? So just like a mutual fund pulls in partial units or partial shares from other organizations, then the fund wrap pulls in multiple mutual funds into its own fund, okay? Okay. So with a fund of funds, the client owns units of the pool of mutual funds. And while in a portfolio allocation service, the client owns units of several mutual funds in the proportion established through the allocation service. Thus, in a portfolio allocation service, the investor owns units of the constituent mutual funds rather than units of a fund holding other funds. So that's the difference between the fund of funds and the portfolio allocation service. Okay, so that is the end of chapter 12. We will see you in class next day, and we will review the Q&As for both chapter 11 and chapter 12. Thanks, everyone.